Well, welcome back to the Contrarian, everybody. It's my pleasure to introduce David Hunter for the fourth time now. Gotten to know him over the last couple of years. He's probably been one of the most correct analysts, macro focused that I've been able to talk with. And, he puts out a quarterly letter by subscription. He's very active on Twitter as well. He comes with about 50 years of experience, both on the sell side and buy side. He's worked with some large financial institutions. He's now off on his own, retired, but still writing this letter. David, thank you so much for taking the time to talk with me.
Yeah, hi Logan. Great to see you.
Yeah, David, maybe a good place to start is I know when we first started talking, it was prior to this, longer correction we saw caused by the inflation wave that we saw, kind of caused by commodities spiking. But you were still bullish on the market and you've held on to that. And so far, you've been proven correct in terms of the market really rallying a lot more in the last year than I think almost anybody was expecting. I'm curious, what kind of indications did you see that there was a melt up ahead, that we weren't heading further down?
Yeah, of course we had a melt up in 2020 and 21. So initially, when that got underway, as far as I was concerned, or as far as it looked at the time, I assumed that was going to be that final run into a top. And we had 21-month run from March 2020 to the end of 21, where the market was up more than 100%. Certainly qualified as a melt up. But there were many signs that the market was not complete. There was plenty of more work to do on the upside before the cycle was done. However, I did at the end of 21 say, looks like this thing's run too far too fast and needs a consolidation. And we got that in the first half of 22 and really first 3 quarters of 2022. Um, and but people got so bearish during that consolidation that it was clear that tops don't happen when everybody thinks a top's happened, or bear markets don't happen when everybody's calling for a bear market. And I had, in 50 years, I hadn't seen consensus build to the levels we saw in 2022. I mean, almost virtually everybody was saying this thing has to go lower. There's, and the worries out there were, I had, my long-term forecast was calling for a global bust. That was not a term anybody was using when I started talking about that. And all of a sudden in 2022, I kept hearing my terms being pushed back into the forecast. There were lots of people calling for a bust and lots of people nervous about this being, the biggest crash ever and all things. It just became pretty obvious that sentiment had gotten too extreme to the negative side, and that, the Fed was tightening. So there was reason for near term negatives, but that ultimately I felt things were not at that point. I mean, the bust was coming, but it wasn't coming in 2022. And then we got to a point where sentiment was just so extreme um, in October of 2022 that it was clear we were going to have another leg up. And I said the next leg will be even steeper than the last one. So even though we had a melt up in 20 and 21, it was pretty clear to me that we were going to have another melt up, and that's unprecedented. It was nothing in history that I saw that I could compare that to. But that wasn't my concern. I'm focused on what my analysis tells me about today, and um, that was basically where it came from. And then it was clear to me that at some point what would happen is the Fed would go too far, or the inflation was coming down through all of that tightening, and that the Fed would at some point have to go the other way, and that would be just ending tightening, because tightening had been such a strong headwind. Just ending tightening would serve as a big catalyst for the upside. Didn't need to predict rate cuts. Didn't need to predict big easing. Just taking that headwind away and making it so that you didn't have that stiff headwind was enough to get this thing going, and then we'd see where it goes from there.
Okay. So mainly sentiment driven, because I know people have always said, probably even for the last decade or more, that the markets are overvalued on a historical basis. So it sounds like it's not coming from kind of a fundamental assessment. It's more so sentiment, perhaps.
Well,
Or
it's both. I mean, I do agree that long term, we're at the higher end of valuation. My analysis, as I always say, includes fundamental analysis, technical analysis, macro analysis, um, cross market analysis, and sentiment. And all those things are a piece of what got me where wherever I am in my forecasts. I never rely on one thing. If it's not confirmed by the rest of it or most of the balance of my analysis, I can't have the convictions. And this was a high conviction call. So sentiment certainly was a big part of it, but the technicals told me very much that we weren't done on the upside, and fundamentals valuation is not usually a good reason to call the top, you know, because valuation could get more extended. And people in the past year, people got very caught up in, it's a narrow market. It's the Mag Seven, the Magnificent Seven. The rest of the market is not participating. This is a sign of a very poor market rally. Um, and they were, and yes, you had valuations up in that area, but at the same time, the balance of the market was pretty reasonably priced. So you had through that bear market in 2022 actually brought the market back down to a decent valuation level. So valuation didn't scare me at that point.
okay. I guess where you see the melt up now is we've been in it since maybe the bottom in October 2022, and I guess around the beginning of the year we had a short consolidation. But from here, do you see it continuing to accelerate to the upside? And as you just mentioned, probably broadening to include some of the laggards like small caps.
Yes, definitely. Just to clarify, I believe a new bull leg. We had a bear market in 2022, but in October of 22, with the S&P at 3,500 ish, um, we began a new bull leg, um, and the melt up portion of that bull leg, I believe, began in October of 23 or early November, late October, early November of 23, when the market pulled back from 4,600 to 4,100, or just under 4,100, and then turned sharply upward. If you remember early November, you had some very big days, and that thrust told me we were off to the races, that the melt up had begun. And so I think we've been in the melt up since then. So, and we've had, obviously we entered this year after 2 strong months, um, with about 3 weeks of consolidation, high level consolidation. The S&P didn't correct much more than a little over 1%, and Nasdaq a little over 2%, I think. Um, so high level consolidation, but it did kind of underneath the surface correct. And now it looks like we've broken out. S&P is at all-time highs now to join the Dow that had already gotten there. Nasdaq will be at all-time highs, I think, in coming weeks. So you're looking at a breakout into what that means is if the melt up started 2.5 months ago, um, then it's just going to steepen as we move along. Doesn't mean you won't have down days or even down weeks. I just don't think you're going to have long extended pullbacks, and I doubt that you're going to see pullbacks that are bigger than 2, 3, 4%. That can they be bigger than that? They could, but as you steepen, you just have less room. With any pullbacks, I think will be short and sharp.
Okay. What sort of top performers do you see coming in the melt up that maybe have lagged so far?
Certainly, I think the cyclical area, what we would call the value area of the market, a lot of the industrial cyclicals, particularly in the commodity producer area. So XLB is the materials ETF. That to me will turn up and be a an outperformer. XLI, which is the industrial ETF, has already gone to new highs. Has had a high level consolidation. I think that will continue to perform well. Um, steel to me is a group that's lagged and is going to have a pretty strong period here ahead. Copper, again, a laggard that I think is just beginning to turn back up. Um, Home builders have been strong through this, surprisingly strong. In the last year, I think they will continue their strength. Obviously they've come a long way, so they may not be one of the leaders, but I think they'll continue to perform pretty well. I'm not ruling out. There are people on two sides of the fence in terms of technology. Some who say, "Well, they're done. They've had their run. They're going to underperform." I don't necessarily agree with that. And there are others that say, it's only technology that's going to keep going. The rest of the market's going to, it's not again, it continues to be not a true bull market. I disagree with that. So I think technology will be part of that broadening of the market. It will continue to perform. I think semiconductors still look great and will continue to outperform. Again, they've come a long way, so you can have short, sharp pullbacks, but ultimately they're going a lot higher. Um, let's see, the laggards, things like utilities and consumer basic, I expect will continue to lag. Um, Consumer discretionary is kind of a mixed area where you could see some catch up in some of the things depending on what shows here. I just don't have as much conviction on autos and airlines and things that have lagged behind because they depend on the consumer staying intact, and I think the consumers, it's getting harder and harder to see the consumer keep up the pace. Um, so those are things that I think it's a mixed bag. Um, Obviously, EV has taken a hit lately, and some parts of that I think will continue to lag. Other parts might, like Tesla could reassert itself. Um, so let's see. I'm trying to think what I'm not a big fan of healthcare. There are a lot of people calling for that to be one of the leaders this year. It may or may not, but because it got hit pretty hard last year. But I still think it's a problematic area going forward. So, can always have a period where it gets responsored, but not an area I'm focused on. Energy, obviously, I think is a laggard area, an area that will continue to underperform. I continue to have a $60 target for oil. Oil had the big rundown into the mid 60s, rallied back to 95 last year, and then came back down into the high 60s. I think we're still working our way lower. So, that's an area where I would stay pretty cautious in terms of my outlook. Um, Again, because it's come down, there are always chances for counter trend rallies. I just don't think it's a leader.
Okay. And I know your targets for the last few months have stayed approximately where they have been. Have you raised any of your, I guess, melt up targets on any of the indices or anything like that recently?
Yeah, my first quarter letter, and it's usually where if I make changes, I make them in my letter and go from there. In my first quarter letter a couple weeks ago, I did raise my target for the Nasdaq from 20,000 to 23,000. For the Dow from 48,000 to 55,000. For the Russell 2000, I increased that from 3,000 to 3,300. And S&P, I had a target of 6 to 7,000. I didn't really raise it, but I did drop off the lower end of that range, and my target now is 7,000. So, again, my convictions are high that this melt up has legs. By the way, just to finish out, because there was one important group that I left off discussing the sectors. I think finance will be a leader in this rally. So, finance, the financial sector had lagged for much of the first part of this rally, last year plus. But I think it's going to have catch up. So that's an area that's probably more on the value side, undervalued, and also beginning to show signs that it's turned. So I think that's a group that will help to take us to the top.
So, David, how would you maybe explain the consolidation, maybe lack of enthusiasm so far in the gold and silver space? And then what are your current targets for gold and silver?
Sure. My targets have not changed. I'm still looking for 3,000 for gold pre bust. So sometime this year, and probably first 2/3 of the year, I would guess, maybe sooner. Which is pretty. If it gets there that fast, that's pretty fast. And also 60 for silver. Again, if we saw that this year, that's a huge run, but I do still have the same convictions in terms of gold and silver. My call's been very premature, as people on Twitter remind me all the time. It's been a frustrating area, particularly silver. It can't get out of its own way. But as I remind people often, markets move when they're ready, not when we're ready, and sometimes that is a big divergence between what we expect and when the market's ready. So I do think we're very close to a major turn there. I think yesterday was a reversal day in gold and silver to the upside. Today it's more of a fill-in day. They're backing and filling. Some might even go to a lower low today, but generally, I think the miners. But generally, I think we are in the process of bottoming and turning up. And I do expect a pretty strong first half in gold and silver, and probably spill over into the summer. Um, so yeah, I like gold and silver a lot. The metals and the miners will be another area that should perform very well during the melt up.
Okay.
And the reason I think that it's lagged to a great extent is because the dollar is held up. The dollar had a big decline from 115 down below 100, but then it spent the last many months consolidating that decline. So, until it rolls back over, I think gold and silver have been kind of biding their time. And I think that rollover is about to happen. I think the dollar counter trend rally, I think, is pretty well done. Once the dollar heads lower again, I think we'll probably see it fall from the 103.4 area that it's in down towards 90, and then ultimately down towards 80. So I think there is, again, lower interest rates, lower dollar, and sharply lower in both cases are going to be catalysts for the gold, silver, and miners.
Okay. So sounds like bonds could see a pretty sizable rally even in the melt up prior to the bust that you see coming. Um, would real estate then also play into the melt up a little bit? Or I know you say that real estate's probably going to get hit during the bust.
Yeah, it's because I am bullish on bonds and do think that we could see a 2.5% 10-year during the melt up, meaning between now and let's say it's summer sometime. If we get that, you could see a sub 5% mortgage, or certainly a 5% mortgage rate again. You get it down there, 4.5%, 5%. You're going to have some of that pent up demand that missed. So we can't afford that house we were looking at now because rates went up, mortgage rates went up to almost 8%. Now that we're back down under 5 or down to 5 or under, maybe we should rethink, go back in. So I think you'll see a bounce probably late winter into the spring because rates are down. If I'm right about the bond market, and I feel pretty confident that again bonds are another place where we had a big rundown on the 10-year from 5% to 380, and we just backed up to 420. We're 413 today. I think that's just a consolidation of that big drop, and then it'll resume the drop. And once we finish this consolidation, I think that's largely run its course. So next stop is probably 350.60, and then down from there. Like I said, I think we could see 2.5 on the 10-year. Again, that probably translates into a sub 5% mortgage or something close to that. And I think that is stimulative to housing. I would just caution though that it's you're at the end. I think we saw a peak in housing maybe a year ago or somewhere around there. Um, and any bounces here are in the context of a rolling top. Ultimately, I think in the bust you could see housing get hit pretty hard.
Okay. So maybe moving on to the bust and almost what would make you start to be bearish at the top of the melt up? Is it sentiment as well? Like everybody's starting to be bullish and saying that this is the beginning of a new secular bull market, and would it be language kind of like that?
Yeah, I'm a contrarian. I'm the contrarian out there probably. So sentiment always is important to me, and at tops and bottoms, I'm pretty alone. So yeah, when everybody is telling me there's a long bull leg ahead, or that there's clear as the eye can see, or gee, we're there's nothing here to be bearish about. They're giving me the bullish story that I've had for a while. When everybody's all in, I'm going to be out. I'm going to be starting to get very nervous. And I just caution people, it's it's not a simple thing to go against the crowd, because a crowd can be right for a while. So don't just knee jerk it and say, "Oh, everybody bullish, I'm getting out," or "I'm hearing a lot more bulls, I'm getting out." I'm getting that already. People sound like you. Isn't it time to go the other way? And I go, it's just beginning. There's a time when the consensus is right. So, be careful trying to be a contrarian when you're not one, or when you've never practiced it, because it's easy at tops, or easy as you get to the top, to be early and then feel like you missed something. So, but from my perspective, yeah, when I see everybody's all in, I'm probably going to be starting to get pretty bearish, and of course they're not going to be all in because everything's getting bad. They're going to be all in because there is a narrative there that they can buy into that looks pretty bullish. So it's not going to be as easy as you think to say, well, when everybody's all bullish, I'm going to be bearish. It'll be hard to fight, just like it was hard to fight at the bottom. There are lots of people that would have loved to have been bullish at the bottom, but they were scared to death it was going a lot lower. So not just market momentum, but some of the data and information that surrounds the top will make it hard to be bearish. But yeah, I suspect sentiment will play a big role for me, but I'll also be seeing other signs that as I've said for a long time, the seeds the seeds to the bust are sown way ahead of time. They're not something that just happens because the Fed you know raises rates some quarter when everybody thought they should have gone the other way. It's what they've done over a period of time, and not just the Fed, other central banks, not just that, but certainly the fragility in the system. All those things will play a role.
Okay, so I know you've mentioned a lot that the seeds for the bust have been sown, that there's really no way of maybe preventing it at this point. Um, is there maybe a way in which the bust could be averted, or I guess is it regardless kind of baked into the cake at this point with how much the Fed has tightened? Maybe probably more than they needed to.
Yeah, it's what I never say that it's all baked in the cake. I think a lot of seeds are sown. I think the seeds to the bust have been sown largely, but I think there's more to come. I would not be surprised if the Fed if we get this melt up to almost 7,000, or once we cross over 6,000, I think you'll see the Fed. You're already seeing it. They're very uncomfortable seeing the market go up, so they're not ready to hike now. But I think if you get this market up over 6,000, you're likely to see the Fed say, "Whoa, all this talk about easing, we're way ahead. You're way ahead of the game. We need to tighten." And I think you could see them come back again, even if they cut sometime between now and June. Um, they could come back and reassert themselves on the tightening side. Even they're not going to say, "Oh, we cut in March, we have to cut again, or we can't hike." No, if they see things heating up, they'll probably come back the other way again. And they may be doing it just as the economy is really under the surface starting to weaken. So there's more seeds that can be sown, I think, ahead. But largely, yes, the Fed's already over tightened, in my opinion. The central banks around the world, ECB, et cetera, have already over tightened, because what are they focused on? They're focused on inflation. Inflation's probably a 2-year lag to your policy. That means they're 2 years late. If they're going to wait until inflation's at their target, um, they're well into being too late. In terms of going the other way. So I think leads and lags really are something they struggle with, have always struggled with. That's why we have boom and bust cycles. Um, and I think in this case, it can get complicated because they're so focused on inflation. They're so worried that it can break out again that, like I said, if they see any reason to say, "Gee, you guys are heating this up again," they're going to go the other way very quickly. And I've said before, um, I think Bill Dudley's whole thesis that he put forth in April 2022 at a speech and has reiterated many times about the equity markets being a big part of financial conditions, and unless you get the equity market down, you really haven't tightened. Um, Powell took that to heart back when he said it, and as that's you can tell that's resonated with him ever since. That's why I think Fed continues. Yes, they're very definitely focused on the economy. They're very focused on inflation, but there's this third thing they don't always talk about, but they're also, I think, quite focused on the stock market, both because of Dudley's speech and his thesis, but also because they received so much criticism, the Fed as a whole. And, Powell's heard it enough times about the Fed put and the fact that we kept rates far too low for too long and that they were just propping up the market. He's stated many times, and you can tell he really believes it. He does not want that to be a part of his legacy going forward. So he's dead set against um, Fed put, and so may overreact on the other side. You know, paying too much attention to the market and not realizing the market's not up because of the Fed. The market's up for other reasons. Um, and if the Fed thinks they're in charge of the market, or that it's going to be perceived that they're the reason the market's propped up, they could make a big error on that. So there, could be a series of errors that get made that lead to the bust.
Okay. And I know the bust that you've talked about, it could be pretty sizable corrections that happen in the indices. I mean, you've talked about the S&P being down maybe as much as 80% and other indices as well. And you've said that, I guess in your mind, the two assets to hold up during the bust will be treasuries and the dollar. Is that still correct?
Yes, I think the dollar will get a bid as a flight to safety trade. So we've seen in history, and I don't think it's changed, even though everybody's thinking the dollar's losing its luster. But I think in times of crisis, world crisis, we saw it certainly in March 2020. People run to the dollar, people around the world. So and dollar assets. So I still think we'll see that as if you're going to have, if my forecast is right, we're going to have the biggest financial calamity maybe in history, but certainly in the post World War II era, so worse than 2008 and 9. It only stands to reason that people around the world are going to be looking for where can we flee for safety. And I think the dollar still becomes the one liquid asset that they will run to. So I think the dollar, as much as I'm bearish on the dollar this year, I think during the bust you could see it completely do a reversal, a 180, and go back beyond the 115 high we saw a couple of years ago. I'm saying 120 plus. So whether it's 122 or 140, I don't know, but it's probably, I mean, that if it goes from 80 to 120, that's a 50% run, and will happen probably pretty fast during the bust. Could carry a little beyond the bust. Um, but that's kind of the magnitude of what I see coming in the dollar and treasuries. Again, the U.S., as much as our debt is building up too fast, way too fast, and we have big deficits, and financially, I think we're heading for a disaster. In spite of all that, the world still sees us, and correctly so, still sees our government as probably the stablest government in the world, or the one that you can most trust your in terms of the backing. So the government guaranteed U.S. Treasury, government guaranteed securities, where you can get your money back, or where people still believe you will get your money back, will be getting a bid during a bust as well. So, and at the same time, I mean, I'm expecting um, inflation to go to deflation in the bust. So you've got that going for you for bonds, and government guaranteed bonds. And, the Fed's going to have to print money like it's never been printed before, to the tune, my estimate is to the tune of $20 trillion. And to put it in context, we had 5 trillion expansion back in 2020 and 21. And so this is 4 times that. To do QE to that magnitude, QE means you've got to buy bonds. I mean, you're a big part of QE. There could be a direct window from the Treasury to the Fed at some point during the bust, but ultimately you're going to be monetizing the U.S. debt. If you're monetizing, if the Fed is buying all that debt, you've got a huge bid for the debt. That means rates go down, and at the same time, you're gonna, the Fed's buying them. So are institutions, so are individuals saying, I want the safety of the U.S. Treasury. So lower rates, deflation, and the Fed all going in the same direction will push. I think you'll see a 0% 10-year during the bust, and as I've said, I wouldn't be shocked if it goes to negative territory. I think short rates definitely, shorter paper will go to negative territory. And the 30-year probably goes to, a quarter or a half, something down there.
Okay, so you could see some pretty sizable rallies in the bond market too during the bust.
Yep.
I'm curious, uh, there's a lot of talk of, the US election and how that might be playing into the markets with the melt up or with the bust. I mean, does that play into your outlook at all in terms of how the US election might affect that at all?
I I think certainly it's going to be part of the narrative. It's an election year, and there's enough people out there, strategists and money managers, that believe the election cycles stuff, and believe that they do. The current administration does juice up things during elections so that they have things going for them at election time. So, I mean, to a small part, I suppose that will play a role, and certainly will be part of a narrative. Personally, I don't think the election is the reason we're getting the melt up. I think the melt up would happen even without this being an election year. It's there are just other factors that are so much bigger than that but I can't say that that's not going to be part of the narrative. I think it certainly will be.
Okay, so it almost could play into part of the narrative that people start believing once you get closer to the top of the melt up, perhaps,
Yeah,
rather than the cause of it itself.
yeah, yeah. Well, I think it'll be part of the narrative all the way up. I mean, people are starting to get more bullish now, right? Why are they getting more bullish? Because of the tape, really, because the market's acting well. I mean, that's really what drives the market is the FOMO. People go with the momentum, and then the narrative follows. So the narrative will probably be there on the way up. But as I say, I think it's a small part of the narrative. I think there's other things that are really going to be, the bigger part of it, which is the lower dollar, the lower interest rates, and the it's kind of a race against time in terms of the economy. But if the economy can stay intact, just flatline, slightly positive, you get this narrative of much lower rates, lower inflation, the Fed being done with its tightening, and a soft landing. And I think so. It's kind of a cake and eat it too type of scenario where people say, yeah, well, the economy's not even going into recession. We've got, rates coming down, so P multiples go up. We've got inflation coming down, and the Fed doesn't have to tighten anymore. And in fact, we're starting to count on rate cuts, um, meaning easing. We can look over the trough and we can look to the other side, and that trough isn't even it's a shallow trough because we're having the soft landing. That's kind of what I think the general narrative is for this melt up, particularly if it happens in the first half of the year, as I suspect it will. Um, and so you throw in a little bit about election year cycle or about you know things being propped up by the administration to make sure things look good for a reelection. But I think that's just kind of a side show, a little throw into the. You don't need it.
Okay, I guess maybe we could start to wrap up. I'm wondering, like, what advice you might generally have for people. Obviously, not individual stocks or anything like that, but it sounds like during the melt up, most people might be tempted to get in close to the top with how euphoric everything will get. And then in the bust, everyone will probably be, on average, hit kind of hard, at least in their portfolios with that. How might your average person, maybe a young person like myself, or just your average person, be able to hold up during what you see is likely?
Yeah, I'm a macro strategist and have to walk a very fine line, make sure I don't put advice out there. Even, I certainly don't make recommendations and can't give personal advice. But what I can say philosophically is, well, the reason I'm a 50-year contrarian is because I noticed very early on, and it was reinforced every cycle, is that you know people tend to get most bullish near tops and most bearish near bottoms. And you're going to see we got very bearish 2 years ago, or even a year and a few months ago, and we've been kind of gravitating a little bit in the direction of more bullish. We're now, with the market going to new highs, we're now going to see that bullishness continue to build here right into a top. And I just caution people, remember that things can look brightest, or all the stuff you'll see on in the media, CNBC and Bloomberg and elsewhere, is going to be much more bullish as we move closer to the top, as this thing continues to show momentum to the upside. So you have to, as an individual, guard against getting caught in that, and at some point maybe go the other way. I can't give any advice in terms of how people structure their portfolios, or you know whether they go to cash or whether they buy bonds, or what that they'll have to talk to their advisors or figure it out for themselves. What I can just say is that that's how sentiment works. Is that when things look the best, it might be time to really start questioning, what am I paying for that? How don't forget when you're near a top, people have acted on that. When people are most bullish, they've already acted on that bullishness. So certainly the so-called experts, or the money, the big institutional money managers, when they're most bullish, they've already acted on that. They're not telling you what they're going to do. They've done it, generally. And when they're most bearish, they've already acted on that bearishness. So what's going to follow that? So when you're at the top, just remember, in the aggregate, most investors are already in. They're already acting on that bullishness. So it's what's going to come after that is what you have to ask. And it's kind of a not even just about the melt up or the top. It's really, as investors, think about this all through your investment career or investment lifetime. Is always ask that question: is you know yes, they're the experts, but they're all in agreement. What are they getting wrong? That's kind of the $1 million question you should always ask. And again, it gets tricky because, and I've said this lately, if I'm right about, my targets, they're almost 50% targets from here. We've moved up a little, so maybe not quite, but 50% type moves. Those usually to see the market up 50% happens over 2, 3, 4 years. Um, if it happens in the first, let's say, the first half of this year, or whatever it's going to take, it's going to be short. Um, that Yes, you're close time wise, and so you should be starting to think about what am I doing here. On the other hand, if you're premature and say, wow, gee, the market's come a long way in the last 3 months, or the market's come a long way in the last 15 months, and you get out here, just realize that you might sit and say, I got out 50% too soon, you know, um, and what I fear more for investors is that they stay cautious here because they say, well, I'm just not smart enough to be able to call it to the next few months or next 6 months. But then I know how psychology works. And then, you know, 30, 40% higher from here, they're going to jump in because they fear that they misjudged everything, and so then they get in much closer to the top and never did get the return. So again, I'm not telling people to buy. I'm not telling people this is a good time to get in. I'm just kind of telling you how psychology works, so that you can think about that in your own context.
Yeah, I think that's great. Just overall wisdom to give to people in terms of how to think about this and what you see as likely coming up. Um,
It's a very difficult business. I got to tell you, the majority of just looking at it through my 50-year lens, but you can certainly read books on this, etc. Investing is a difficult thing, and investing in the stock market in particular, um, it seems confusing to most retail investors, and certainly must be confusing to a lot of the institutional investors who get it wrong because there's plenty of underperformance. It's a very difficult thing, and just adding that understanding of psychology, that piece, can really help you. I mean, that's all I really would say. And I often on Twitter recommend one book. It's a book that was written back in 1977. It had a different name then. I read it the year it came out. I was already a contrarian, so it didn't necessarily. For me, it was easy reading because it was just speaking my language. But I also, when I read it, said this is a book everybody should read, and I haven't forgotten that from that day. It's changed names because there were revised editions. The author's since passed away many years ago, but his name is David Dreman, Dreman. He was a well-known contrarian, wrote for Forbes, weekly column for Forbes, or monthly, I don't know. Had an investment firm, but was actually Canadian, but was managing money in the U.S. Um, and the book is just a very straightforward, simple read that explains investor psychology and the importance that psychology plays. It's a very powerful role it plays in markets and stock market in particular. And I think everybody would do well to read that book. I think it may have been, I don't know if the last edition was in 1998, but that kind of rings a bell maybe. And it was called Contrarian Investment Strategies. When I read it, it was um, this, psychology in the stock market or something like that. So the title changed, but it was basically just revised revision of the same book. So I encourage people, and I have had plenty of feedback from people that took my advice and read it and said, "Yeah, that was a really helpful book for me." So I just tell everybody that they should. It's an easy read. It's well worth the time. And I don't
Okay,
obviously I don't get royalties out of this, and he's passed away, so it's just like I said, I read it in '77, and it's always stayed in my mind that that's a book everybody should read.
yeah, well, I will put the link to whatever PDFs available or book links I can find to David Druman's Contrarian Investment Strategies. David Hunter, thank you for taking the time to talk with me today, update me and my viewers on your outlook. And I know you're very active on Twitter at Dave H. Contrarian. You also release a quarterly letter by subscription. Maybe just let my subscribers know where they can find you if they want to hear more.
Sure. Yeah, I put out a quarterly letter. It's all macro based. It's not no advice. It's a lot of what we talked about today, but it's updated quarterly, and it gives me. I'm on Twitter, so I reply to people all the time, and hopefully through the replies, people get a pretty good sense of my views. But obviously a longer form letter allows me to kind of fill out my rationale, and I know the people that do subscribe say that it does really help them. So it's not for everybody. It was an institutional letter when I started, but I realized that I'm pretty plain spoken, and so it wasn't hard for retail to read it and understand it as well. So in the last 3 or 4 years, I've made it available to retail and retail investors. So if people are interested, it comes with a cost, and it's an annual cost. So you pay for a subscription for a year. You get 4 letters, sometimes 5 if you subscribe right near an old letter, like a month after I put out an old letter, you get that one, and then 4. Um, so, but it's the best way to find out about it and the cost, et cetera, is to direct message me on Twitter. I don't have a website. People come on Twitter and say, I can't find it. No, you can't find it because I don't put it out on a website. It's something I write and make available to my subscribers. So just direct message me and I'll get back to you with details.
Okay, David, thank you so much.
Hey, Logan, great to see you, and stay well.